Hi, I'm Barry Norris and I'm here to talk about the Argonaut Equity Income Fund.
Who is the fund aimed at?
It's aimed at investors who need an income from their investments. So at a time when interest rates on cash and bonds are very low and indeed have been negative, only equity income through dividends can provide a really attractive yield as well as the prospect of capital growth.
Tell me about the track record of the fund.
So we launched the fund 4 years ago, since when it's delivered over 45% and paid back almost 20% of the original capital to shareholders in the form of dividends. So we've generated an annualized double-digit return, of which around 5% per annum has been in the form of dividends. And that's worth saying is better than the peer group, not only of European equity income funds, but also global and UK funds, and almost twice the dividend yield of those peer groups as well.
What is the yield on the fund and when does it pay out?
So the yield of the fund is currently around 4.5% based on what companies paid in dividends last year. However, if you remember, lots of companies cut their dividends last year, either because they were forced to do so by financial regulators or because of the uncertainty created by the economic lockdown. So this year we're expecting dividends to significantly increase from last year, not only because profits are going to increase, but because dividend payouts are also going to increase. The fund pays its dividend on a quarterly basis at the beginning of each quarter, but as most companies pay their main dividends in the spring, the main dividend payout on the fund will hit the investors' bank accounts in roughly July of this year.
Equity income funds have largely underperformed growth-orientated strategies for nearly a decade. Why is this and why might it now change?
Very good question. So since the great financial crisis, economic growth has generally been pretty anemic, certainly in Europe, and most companies have struggled to grow their profits. So lots of dividend stocks, which are often value stocks, have ended up being value trapped. Their share prices have often declined because the market has worried about how sustainable those dividend yields are if profits aren't growing on an underlying basis. So this is why value stocks perform well actually when there's a lot of economic growth, because the average company can grow revenues, profits, and therefore dividends. So the global economy has now had some really significant, not only monetary, but now fiscal stimulus. And obviously there's a lot of pent-up demand also coming out of lockdowns. Therefore, 2021 should actually be a record year for economic growth, following obviously a record terrible year in 2020. And that's why I think value dividend equity income strategies will generally perform well this year. And I think this fund, the Argonaut Equity Income Fund, will perform particularly well this year.
The fund invests predominantly in Europe. Why is this?
It's rather like when Willie Sutton was asked why he robbed banks, because that's where the money is, he replied. Most of the world's most attractive dividend stocks are European. By Europe, we mean the whole of the continent, including Eastern Europe. And we certainly think Russia is particularly attractive at the moment. The fund has some flexibility in investing outside of Europe, and we certainly utilize that if we find really attractive ideas. And ultimately, the fund may go global in its remit, but for now, we believe that Europe will be a very good place to be for an equity income strategy over the foreseeable future.
How many stocks does the fund hold? And can you give me a few stock examples?
Well, we believe in adding value for our stock picking, so we run a concentrated fund of around 30 stocks. Let's talk about our top 3 positions right now. The first is Porsche. You'll know Porsche from the luxury car brand, but it's actually from a stock market perspective, the Porsche family holding company for its investment in Volkswagen, which owns the Porsche brand as well as many others. So why is that attractive? Well, at the moment, the Porsche holding company is trading at a 45% discount to its investment in Volkswagen. So we are actually investing in Volkswagen at a significant discount to anybody investing in Volkswagen directly. So if the shares traded at NAV, at its net asset value of its investment, then the Porsche shares can double without even the Volkswagen share price going up. However, we think Volkswagen is one of the most attractive equity stories in Europe right now. That's because until recently, the market was very worried about electric cars and the effect that they would have on Volkswagen's legacy petrol and diesel business. However, it's become clear that the opportunities for Volkswagen from electric cars are actually immense. And you had a situation until very recently where the market was recognizing those opportunities for a company like Tesla, but not recognizing any of the opportunities for a company like Volkswagen, despite it having considerably more experience and resources in this area. So at one stage, Tesla, the value of Tesla was 10 times that of Volkswagen, which we certainly thought was absurd. So now I believe the market is recognizing this opportunity in electric vehicles, that over the next few years, a lot of people will be changing their cars, and Volkswagen within its stable of brands will have some of the best electronic vehicles out there, and that will result in significant opportunities, not only in sales, but ultimately higher margin software sales at the company. And we also think, if you look at Volkswagen's brands, it's got a number of luxury brands in there, like Porsche, Bentley, Ducati, Lamborghini. All of these, if quoted separately, would attract very high multiples, like Ferrari, which is considered now a luxury goods company. So all in all, I think Volkswagen is probably the best self-help story in Europe. It's a cheap stock with great growth potential, and for investing in Volkswagen via Porsche, we are, I believe, getting in at an extraordinary cheap price for a company that also pays out nearly 100% of its profits as dividends to its shareholders. Lukoil is another stock I want to talk about. It's a Russian blue chip oil company. So why do we like an oil producing company as well as electric vehicles? That's a very good question. I think whilst we believe that demand for oil will stagnate and eventually decline, it also has to be viewed relative to supply in the oil industry. And companies in the oil industry are simply generally not investing anymore for future production growth. So we actually believe that the oil price, even though demand is probably declining, will actually increase in price, because not only of the lack of current production growth, but simply the discipline that we're seeing amongst oil companies in terms of not spending money for future production growth. So we wouldn't be surprised, therefore, if oil actually went back above $100 a barrel, which seems extraordinary, in the next 12 months. Lukoil will be a great place to benefit from this, because it has access to a lot of easily drillable, discoverable oil reserves in Russia. It will therefore be a supreme cash cow at a high oil price, or indeed even if it was a low oil price, Lukoil would still make money, and Lukoil will also pay nearly all of its profits back to shareholders in the form of dividends, which we think therefore will be an excellent investment opportunity going forward. Finally, Swiss Re. What do we like about Swiss Re? Well, it's the world's largest reinsurance company. Reinsurance is, if you like, what insurance for insurers, what insurance companies buy to help diversify their own balance sheet risk. Last year was a difficult one for the reinsurance industry because of the losses caused by COVID and the insurance payout that underwriters had to pay on that. But often the best time to invest in the reinsurance industry is after a negative event, because new capital gets higher rates of return as those contracts are priced at a higher rate, reflecting the recent risk. So not only do we think underwriting results will be better, but we actually think because interest rates are rising for very low levels, the investment returns for Swiss Re, like many financial companies, will also increase. They'll get a higher return on their insurance premium flowed. Therefore, better underwriting and higher returns means that a share that is already modestly priced with a generous dividend yield can, we believe, return more to us over the foreseeable future.
Do you invest your own money into the fund?
Yes, I was actually the first investor in the fund, and I seeded the fund from launch. So if you like, I've been eating my own cooking.
What do you see as the biggest risks to investors this year?
Well, that's another good question. We think the risks to markets in 2021, and therefore also the opportunities, will be very different from those witnessed over the recent past, in that we think there'll be actually an abundance of economic growth, but because of that growth, investors will come to question whether a zero interest rate environment is appropriate anymore, and therefore whether low interest rates will last. And therefore we have to look at what's been the beneficiary of very low zero interest rates. It's been the bond market. Bonds have generally gone up as interest rates have gone down, and it's been high growth stocks that are high growth but high valuation, but will pay out or earn a lot of money in the future, but maybe not much over the next few years. So if you like, stock market valuations are at risk, but not stock market earnings. As a general rule of thumb, when interest rates rise, stock market valuations go down and vice versa. So this means that the risky parts of the financial markets this year will be bonds, and there'll be long duration equity investments. And by long duration, we mean high valuation equity investments that are most sensitive to the price of money. Unlike our absolute return fund, which hedges market risk through short positions, this fund, the Equity Income Fund, is 100% exposed to the market. So everything we are investing in is for a positive reason. So we have 100% exposure to the market. So that in many cases would seem more risky, but to my mind, the risks in the equity market this year are in growth stocks, and this strategy avoids growth stocks because it invests in high dividend yield stocks, which are generally low valuation and generally stocks that will do much better in a high growth interest rate environment and be less affected by higher interest rates. So if bonds and growth stocks are really risky this year, as growth expectations rise, then it makes a lot of sense, not only for people wanting income, because interest rates are not yet high enough to be that attractive compared to equity income, but also for investors looking for diversification from growth areas of the market which have done well over recent years. So very much believe this will be a good time to be an investor in an equity income strategy, and certainly in the Argonaut Equity Income Fund. Thank you.